Hey, it's Chris with Life 180, and today I wanted to talk about the fact that Joe Biden is made a proposal making the top marginal tax rate on capital gains to over 43% potentially for some people. Now, I just want to go through and talk. This is going to be a really fast video because I just wanted to go through the numbers and show what a hazard it is and the unintended consequences that are going to come from this and why this is ultimately going to crash the stock market if this passes. I mean, today alone, the market dropped simply because people were worried about it. People are thinking about it. I think the people who are making the money, who are producing in this country, are seeing it and they're worried, right? With good reason. Now, here's the deal. Just fundamentally speaking, think about it this way. If this passes, it's going to be one of those situations where there's going to be a lot of people in this country where their capital gains rate is going to be higher than the income tax rate. And that is fundamentally wrong on so many levels. Now, here's why. When you are earning an income and you're paying an income tax on that income, the thing with the income tax is there's no risk. You show up to work, you do your job, and then from that work and job, you earn an income, and then you pay back to society, right? In hopes that there's value given back to society in the tax dollars that you pay. And that money ultimately, goes into the production as a whole and you serve the country. The thing is though, as an employee who's earning money, you're taking on no risk and you're just showing up. When I see entrepreneurs and when I see investors getting taxed at higher rates than employees, I have a big problem with it because yes, there's a chance to make more money, but it's the idea of with greater risk comes greater rewards, right? That concept is pure. Like if you want to have higher upside, you have to take on more risk. And there's very few scenarios in this world where that doesn't reign true. And so the problem that I have right now is when you take the capital gains rate and you move it over 40%, what you're doing is you're saying not only are you going to have to take the market risk on, inflation risk, political risk, monetary risk, all these different things that go into putting your money out there. But ultimately, you have taxation that's going to be sucking out a lot of your gains in the market, right? So if the capital gains rate was 20%, now it jumped to 43%, you're taking on basically 100% more risk because it's jumped up that much in your investment. So if that's the case, the smart money is going to look for other alternatives, right? That's just the way it is. And here's why. I want to show you the math behind why. And I got a little spreadsheet here that I just threw together just to make it really, really simple because I think it's really important that people see this and how simple it is to understand. So imagine somebody had $100,000 right now in an account that was like a normal brokerage account where they're going to be able to, have to pay capital gains in the account. They had a return of 10%, and I just had, it'll never happen this way. This is just kind of a model, but let's just say it earned 10% per year. You can see the gain in the first year is 10,000. Capital gains paid, because remember, they're not paying capital gains on all of the 100,000, only the 10,000 gain, right? They're going to pay $4,300. That's 43%. That means a 10% gain basically turns into a 5.7% net gain after the taxes, right? So their account value goes to, after taxes, $105,700, right? That's ultimately how it works. Now, next year they got $105,000. It gains, you can see it just goes through. They got a gain of over $6,000, a net gain of over $6,000 because they had to pay $4,500 in taxes. And you can see as the account goes up, they're going to earn more if the returns are equal. But here's the problem. You could say year 1 through 5 right here, you get 10% per year in growth. At the end of that time, even though you've had what should be a compounding 10%, which should be over 50% growth, right? Because it's compounding. The problem is you're paying now such a high capital gains tax rate that you really only have $131,000. So here's why people don't want to take this risk inside of these accounts with capital gains rates so high, because the cost of that makes it impossible to take any downside. Because if you're in year 6, you start the year with 131,000 and the market goes down 20%, which by the way is kind of the norm. Not necessarily every 6 years, but at least once a decade, you're going to have a year where it's negative 10 to 20% pretty significantly, and maybe more. And that's pretty much, I could go decade after decade after decade and show you year after year after year where that, or decade after decade, where that is the case, where that happens, right? So let's say year 6, it goes down 20%, you lose $26,000, you have an account value. Granted, you avoid the capital gains that year because you didn't make anything, but you have an account value now of only $105,000. Think about that. Like, you have an account value that is only $5,000 more than you started with 6 years previous, even though you should be up significantly, right? Why? Because you had to give it all to the government, right? And when you do this, that's a real rate of return, an internal rate of return, if you look at it in those terms, of under 1%. So I could run this out over a decade here, and I haven't done this yet, so I'm just gonna run this out. I think I have this all figured out. Let's go 5, 6, 7, 8, 9, year 9, and let's go year 10. I'm gonna go, let's get this down here. We're gonna go to year 10, and then we're gonna say the market does negative 20 there, okay? And then, we'll see here, what does the market do? It's negative 32, so we go equals this plus this, because it's a negative number. So you got 131,000. So what is this? This goes to show you what this capital gains rate is going to do. It's going to so disincentivize people from investing in the markets. Why? Because you got 10% every year, right? You can see it should look awesome. The market should be doing phenomenal, but because they're taking it away, you only end up with 164,000. You take 20% off that 1 year, it's 32,000. So they start with 100, and a decade later, they have 131,000. The real rate of return in that is about 2.5%, right? Like, I don't know about you, but if I could go put my money into other fixed assets with no risk, right? Because there's a chance that the market, obviously, this 10% uninterrupted average here for the first 9 years, that never happens. It's never that clean, right? So this is like kind of a best case scenario of what their potential outcome could be. This is why Joe Biden is single-handedly destroying the stock market, and it's gonna ultimately obviously trickle down to the real estate markets and other sectors of the economy as well. It's super dangerous, it's gonna be catastrophic, and I think single-handedly, he is going to really, really help the fixed income market, like the companies like insurance companies that sell annuities and life insurance, because I think those products are going to offer such amazing returns compared to what people can get on a guaranteed basis anywhere else, and not even a guaranteed basis. It makes it so you have to get a real return, like an actual return of 8% in a brokerage account, to be able to be the equivalent of what you can get in a whole life policy at 4.5%, right? Like it's mind-blowing. The risk is absolutely crazy. So I am worried that people that sell IULs are going to go out there and illustrate, these crazy numbers, and it's going to be irresponsible. And, I would warn anybody that's looking at illustration rates over 5% with any indexing strategy whatsoever in an IUL, I would steer clear of it. Look at guaranteed money, wait for the opportunity, borrow against assets like a whole life policy, wait for the dip in real estate, buy those assets when the price is right, and it's going to be hard to lose. That's where real opportunity is going to come. I'm going to do a lot more videos on this here as we come up, but make sure, if you haven't already, subscribe to this channel, hit that bell, that way you get notified, because I'm going to have a lot of strategic videos coming up about what to do in this mess of the tax proposals. Because even if this one doesn't go through, which I won't be surprised if this doesn't go through, because this is just horrendous, right, on so many levels. So I won't be surprised if this doesn't go through. But even if this doesn't, this just goes to show the direction that Biden and the Democratic Party are looking to go right now. And even if this doesn't pass, they're going to push for another version of this in some facet. And I promise you, whatever it is that they're looking to accomplish on the tax side of things is going to be devastating to the actual producers of this country. So anyway, I hope that helps. Hope you have a blessed, inspirational day. Once again, make sure you hit that subscribe button, hit the bell. If you have any questions at all about anything, make the comments down below. I try to engage with every single comment possible. I'm not perfect, but I do my best. So hope you have a blessed, inspirational day. I'll see you soon. Take care.